Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Company Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money. Welcome to another episode in our podcast series around breaking down complex financial concepts and developing a financial acumen. Brought to you in association with ICICI Prudential Asset Management Company Limited. In today's episode, we'll discuss Smart Beta ETFs. Of the nearly 1,800 mutual fund schemes in India, about 250 are ETFs or exchange traded funds, including 10 launched in March alone. Excluding old ETFs, there are around 230 other types of ETFs with around 2 crore folios. There are both active and passive mutual fund schemes. Active funds are managed by fund managers and aim to outperform the market, whereas passive funds simply mirror a benchmark index and require minimal management. The fund performance and active approach is highly dependent on a fund manager's expertise and human bias, whereas passive funds deal with this issue but don't aim to beat the market. This is where smart beta approach comes in. Smart beta, also known as factor investing, is a mix of both active and passive investment approaches. It's a rule based strategy instead of the traditional market capitalization based weighting. Unlike market capitalization based ETFs, smart beta ETFs are rule based, where portfolio stocks are selected based on a factor like momentum, quality, low volatility, etc. Today, we are joined by Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, to discuss smart beta ETFs, the factors, and their suitability in the current market scenario. Welcome, Mr. Haria, to this episode.
Hi, Versha, and a big thank you to all the listeners of Outlook who have been supporting us in terms of their support to the phone call. Thank you.
Thank you so much. Let's begin with some basics. We have talked about smart beta in earlier episodes as well of this podcast. I would request you to explain the concept of smart beta once again for the benefit of our listeners.
Sure. So, to put it very simply, as you mentioned, active fund managers, based on their scheme categorization, make choices of stocks and sectors, keep changing them, rotating them. In passive funds, as you mentioned, there is a benchmark index. That benchmark index has to be replicated to the extent possible by the fund manager of the passive fund. There is no leeway of removing some stocks or sectors, etc. when you have a passive fund, and that is why it's called passive. You have to basically follow the index. Within passive funds, what was earlier popular was the market cap based indices, which is large cap, mid cap, small cap, where you'll have top 100 names in large cap or 50 names in large cap as one index, and that was being replicated. Similarly, mid cap and small cap. As we progressed in terms of the journey of ETFs, and as investors became aware and investors started to understand the products moved towards sectoral and thematic. So you had banking ETF, which was popular, IT ETF, which was popular. And again, as we moved ahead, we had themes like infrastructure ETFs, FMCG ETFs, etc. Then we move ahead in terms of the smart beta, as you mentioned, which is again something which is probably there since 2016-17, but is getting more popular now. Because what does smart beta mean? Smart beta means typically selection of the securities is based either on a price factor or a fundamental factor. It is not based on purely market cap ranking of the particular large cap, mid cap, or small cap. So in smart beta, once the universe is defined, say top 200 stocks or top 500 stocks, based on a certain price factor like momentum or low volatility, or
Mhm.
based on fundamental factors like value, um, quality, the selection of securities will be done. And that is essentially what smart beta brings into place. It is essentially a selection of securities which is not based on market cap, but based on price or fundamental factors. And it is something similar to what an active fund manager does when they are constructing a portfolio. Of course, an active fund manager can move between different factors at different points of time depending on the market. But in a smart beta's index, there is already a rule defined. So low volatility will have low volatility stocks, value will have value stocks, and that makes it easier for the investors who want to choose a particular set of sectors or segments within the smart beta to go for it. And I think that popularity has increased over the last 2 to 3 years because investors have become more aware of these factors.
All right, thank you so much for explaining it in detail and so simply. Now, you told that selection of securities based on factors. This is what smart beta funds are. So please elaborate more on how do smart beta ETFs is a mix of both active and passive investing.
So, of course, as far as the index is concerned, the index methodology provides for selection of securities based on price factors and fundamental factors, as the case may be. Like I mentioned, value, quality, momentum, they are the popular ones. Low volatility is also the most popular one. And once the index is defining these factors, the selection of securities happens on these factors. It is very similar to how a fund manager would pick a stock. For example, if a fund manager is quality oriented fund manager, then the fund manager will basically choose those stocks which are showing higher ROC, which have better margins, etc. Similarly, in a smart beta ETF, if the methodology provides for selection of securities with high return on equity, return on capital employed, it will be a similar thought process, right? So that's the while it is not active, but it is an element of active thinking which is coming in smart beta. And once this element of smart beta, active thinking in smart beta comes in, you have a scenario wherein this set of factors is taken into account while creating the portfolio. And once the portfolio or the index is created, all the fund manager does in the passive smart beta ETF is to replicate that particular index, which is created based on the smart beta factor. So, to that extent, it is said that there is an element of active thinking,
Mhm.
while of course the replication of the index happens. So, that is a passive fund, and hence it is a combination of both because of the way the securities are selected on the basis of price or fundamental factors.
Okay. And now, from a retail investor's point of view, who should consider investing in smart beta ETFs? The investors having some surplus to invest in for one time, or those who like to invest through SIP route?
I think all kinds of investors or every investor can invest in smart beta. The only thing is they should understand the risks and rewards attached with the smart beta. And that's the beauty of smart beta, right? Something like a low volatility will be very apt for a conservative investor. At the same time, if a investor who is large and has a very large exposure to mid and small cap and wants to balance the portfolio with a conservative investment, they can do it with adding a low volatility as a balancing factor to the overall portfolio. So, of course, the advisor to the investors can decide what is the mix. But I believe truly that there is a concept called as overall creation of a portfolio, and within the overall creation of a portfolio mix, there is a scope for smart beta ETFs to be a part of every investor's portfolio because smart beta ETFs are providing all kinds of defense as well as attack. So momentum will be on the aggressive side, low wall will be on the defensive side. If you have to be moderate in between low wall and uh, momentum, there is alpha low wall as a factor, a combination of factors. And of course, if someone is quality oriented, long term thinking in terms of quality stocks, then quality as a factor is available. And if someone wants to play tactically when value underperforms for a long period of time, then value is also something which may fit into an investor's portfolio. So, depending on the timing, depending on the market, depending on the overall portfolio construct of the investor, we truly believe that smart beta ETFs, given the range of smart beta ETFs that are available, will fit into every investor's portfolio, no matter how small the portfolio, how large the portfolio is, and also from a risk category, whether the investor is conservative, moderate, or aggressive. There are products which will fit into an investor's portfolio within the smart beta ETFs available in the market.
Okay. And there is a general perception among retail investors that smart beta is technical and is not suitable for them. Rather, it's suitable for professional or institutional investors. So, is this perception true or is it a myth? Would you like to correct?
I think it's not very difficult to understand smart beta if one basically understands what the factors are. Of course,
Mhm.
as far as equity investing is concerned in India, very few people actually understand what equity investing involves, be it in those investing directly into stocks or those who are investing even in mutual funds. The understanding levels are low, and through your medium, through these con calls, we are trying, or through these podcasts, we are trying to enlighten people that it's actually not very difficult to understand, but yes, you need to put in an effort to understand what you are getting into And smart beta, in fact, because it is rule based, it has a methodology, it is not so difficult to understand once you basically put in an effort. So, very simply put, low volatility would have those stocks which are more stable. Once you know the universe, that okay, the top 100 universe, you're picking up 30 stocks. These 30 stocks, which are based on low volatility, will provide stable stocks to your portfolio. It's not too difficult to understand. So, I do agree that in India, generally, the understanding of equity investing is not that strong across, be it active
Mm-hmm.
funds or passive funds. But smart beta as a concept, while it sounds technical, if one actually deep dives and tries to understand it, it's not that difficult. It's just about trying to put your mind to it and understand what a quality factor or a momentum factor. Like for example, momentum. Momentum is essentially those stocks which have done well over the last 6 months and 12 months. So the best performing stocks of 6 months and 12 months are selected, and every 6 months that exercise is done. So that's also one good advantage of passive funds, that there is an automatic rebalance which happens in the index every 6 months, and that keeps changing the underlying stocks. So it's not like the underlying stocks are static forever, but they do undergo change based on these parameters at a certain interval of time. And that is also makes smart beta concept appreciable for the investor. It's not rocket science, it's not that difficult, but yes, people will need to put in some effort to understand, and through your medium we are trying to make it as easy as possible for investors to understand the smart beta. And as always, it's always good to have an advisor who can help you to understand what fits in your portfolio, and they can also easily explain to you what a smart beta is. It's not that difficult.
Yes, so it's not that difficult, and especially in India, there are only 4 or 5 factors which are basically used in funds for the portfolio. Okay, so to my next question. At this time, gold prices are rising. How do you say smart beta ETFs in comparison with gold ETFs? In a volatile market, would gold ETFs not be a safer option? What do you think?
So we've been actually, I think we've had a lot of conversation on gold earlier as well. And since probably 3, 4 years, we've been given that equity markets had done so well, and there's so much debt in the world, so much money that has been printed in the world. We were probably speaking about gold as an allocation, which should be about, say, 8 to 10%. I do remember last time that we did a con call specifically on gold and silver, that we can go as high as 15% also in gold and silver. So now, of course, gold in Indian rupee terms has crossed 1 lakh, or had touched 1 lakh, let me put it that way. In international dollar terms,
Mm-hmm.
$3,500. It is a good hedge against the risks of the a risk of equity or a risk of an economic financial crisis globally. But the attractiveness of gold now has reduced significantly after the kind of rally that we've seen in the last 4, 5 months, right? I mean, gold has been the best performing in the last in 2025, and typically we don't like to chase momentum, or we don't like to chase something which has done very well. And now for 3 consecutive years, gold has done extremely well. So I would be a little cautious in adding gold. What we have, we can hold. That's not a problem. Silver, on the
Mm-hmm.
other hand, just to extend your question, silver ETFs are also available, and that can be something which investors can slowly add on to, because silver has not done as well as gold. While silver has done well over the last 2 years, yes, this 2025 silver is kind of okay, not that great compared to gold. So maybe over a period of few months, one can increase silver exposure to maybe 3 to 5%, and hope that silver goes the gold way at some point of time, because the demand supply of silver in the world, in terms of demand being more than supply, is for 4 consecutive years, would mean that there is a chance that silver can bounce. It has done well in the last 2 years, but there is still some scope relative to gold, is what we feel. But let's see. I mean, silver is more volatile, so to that extent, investors have to be aware that it can be, it can move up and down significantly, because silver is more volatile compared to gold. And gold is a hedge against the global financial crisis. So if there is a global financial crisis, which none of us can predict, then gold can remain elevated. So I think a portfolio allocation is something which investors should keep in mind. But yes, I would still believe that about 10% in gold and silver, with gold being about 6, 7% and silver being about 3, 4%, is a good mix for investors. But try and build it over a period of time instead of building it today. And gold, definitely, if you get it lower, it's better. But today, I would not recommend to add gold meaningfully unless you are at zero.
All right, wonderful key insight that this is not the time to invest in gold, but yes, it is good to hold it if you already have it. Okay, to my next question now. Amid the plethora of mutual fund schemes in the market available now, a new investor may feel overwhelmed and confused about where to invest. So, when it comes to smart beta ETFs, could you explain how one should choose the right option from so many available?
Correct. So, if I look at smart beta, very simply, there are four or five major components. After that, they are variations of those components. So, let's say momentum. So, you'll have momentum in top 200 names versus momentum in top 500 names. Similarly, quality in top or low vol in top 100 names versus low vol in say top 300 names. So, the universe keeps changing, but the factors are more or less four or five major ones. Um, I'll quickly explain maybe each one of
Sure.
them in 30, 40 seconds. So low volatility as a factor, as I've already explained earlier, and very popular in India because stability is something which everyone likes in their portfolio. It's picking the stocks which have shown resilience or have been stable over the last 1 year or so, relatively with the others. So among top 100 names, if 30 stocks have shown more resilience, they will be selected, and then the weightages are on the basis of the factor itself. That's on low volatility. If I move one step ahead, there is multi-factor, which is alpha and low vol, which is a combination of low volatility and momentum. So 50% weightage is low volatility, 50% weightage is momentum. And it's a combination which is meant for slightly more aggressive risk return profile, wherein you're getting slightly momentum oriented stocks while the low volatility also is taken place. So it's an in-between mix between low volatility and momentum. The third is momentum, which is again last 6 months and 12 months best performing stocks within the universe. So let's say the universe is top 100 names and you're picking, or top 200 names rather, and you're picking 30 stocks out of those 200 names which have shown 6 months and 12 months good performance. You'll get them and then they'll get rebalanced every 6 months. That's rebalancing is true for all the ETFs, and it is done by the asset manager based on the changes which happen in the underlying index. Then you have fundamental factors like value. As we know, value underperforms for a short period or a medium period of time, like it did between 2015 and 2020. And 2021 and 2025, value started to outperform meaningfully, and it has been one of the better performers. So value is nothing but, let's say, on price to earnings, price to book, the stocks which are cheap, they will be selected based on a certain universe of stocks. So that's value. There can be other factors also like dividend yield and taking into account. If I look at apart from value in terms of the fundamental factors, quality is one more factor, and quality essentially is those stocks which show high profit margins or have been more stable in terms of their profitability and have high return on capital employed or return on equity, as the case may be. So quality is another factor on which there are ETFs available. Now, these are the four broad categories, which is low volatility momentum, which is based on price factors, and on fundamental factors, you have quality and the fundamental factor
Value.
of value. So these four are the major ones. Then it's basically the combinations or the universe which keeps changing. And as far as investors are concerned, we truly believe that while there is cyclicality in smart beta also, so low vol didn't perform very well between 2017 to 2021, while 2021 to 2025 it is value which has performed and not so much low vol, and momentum which has performed and not so much as low vol. So these factors and their performances are cyclical, but if one has a long term view and accumulates units over a period of time, you set to gain from all the factors which are there in the availability. And some will do well in certain time periods, some will do probably a little less well, but on the longer term basis, because of certain logic with which these indices are created, they would fit well in your portfolio and create the kind of returns that you would expect from a well diversified equity portfolio. So it is something which investors should keep in mind, that it's not very difficult to understand these smart beta ETFs. These are basically the four major components which I have broken down into.
All right, so we have discussed it time and again, and the suggestion is that invest for long term if you are investing in equity, be it smart beta or some other type of equity investment. So the question is, should the smart beta ETFs be a part of the core portfolio for long term, such as for retirement planning, which is like maybe 2 3 decades away, or are they more suitable for short term goals, say 4 5 years, to benefit from the market cycles?
So I think if you are timing the market in terms of which factor will do well, then yes, over 4 5 years you can use certain smart beta factors, right? So for example, if you had chosen value in 2021, it would have done well till now. Then probably now value will stabilize a little and maybe quality will do well, maybe. So it all depends on cycles if you're a shorter term investor. But if you want to really get the full advantage of smart beta, if you're doing a retirement planning for 20 years, 30 years, then I think over a longer period of time, the averaging happens in terms of, all the factors kind of provide the expected return which an investor would probably think that they would get in retirement, because in the long run you will get the best of those factors trying to do well for your portfolio. So if you are doing it for retirement, it's just perfect. You can pick up a couple of factors and based on your suitability and your risk profile, let it run. And over 20 30 years, that should do your job. And the key important ingredient here is to have patience. Plus, whenever there's a sharp market correction, if you can keep adding. So if, say, example, you're doing it for retirement, then every month, if you keep adding over a longer period of time, then you will get the full benefit of equity markets and retirement. If it's tactical for 5 year, then you'll get to keep rotating and then selecting the right sectoral, or sorry, the right factor based ETF, which is not necessarily easy for all investors, and there you will definitely need a advisor to handhold you.
Right, this is not definitely easy for everyone. And lastly, this is my last question. SIPs are considered a safe way to minimize market volatility risk, especially for small investors who take a DIY approach. But this volatility is not limited to market, it also reflects job uncertainty and income instability. So, for those with irregular income, such as self employed individuals or probably small entrepreneurs, what investment strategy would you recommend?
Okay, so ultimately SIPs work well, or SCPs work well in the case of ETFs across. So it doesn't matter which ETF you select or which smart beta ETFs you select. Systematic investing is always preferable because you are investing over a period of time and you're getting the benefit of market cycles as well. So SIP or SEP as a way of investment, let's say an all-time favorite in that sense. The key over here is to continue the investments even when the market down cycle is happening. Now, over the last 5 years, markets have continuously gone up. On valuations, they may not be as cheap as they were 4 5 years back. So to that extent, if there is a correction in the markets over the next 1 year, 2 years, 3 years, investors should not stop their SIP or SCPs and continue the SIPs or SCPs. And there again, the important is to diversify your bets. If you are a very aggressive investor and if you have small cap, mid cap SCPs, it's fine, or SIPs. But otherwise, have a well diversified portfolio in which your SIPs is happening in three or four well chosen funds. As far as lump sum investment is concerned, there is an investor psyche that markets are doing well now. Let me put money and quickly take out money, one make money out of it, or get rich fast. That's
Hmm.
something which is avoidable. And when you're putting lump sum money, be very cautious. So lump sum money, you have to be more cautious than SIP. SIP, it really doesn't matter. You can start anytime and continue it for 10, 20 years and you'll get the benefit of market averaging. But if you're putting lump sum money, be very cautious of where you are investing the money, which sector or segment you're investing that money, and if that segment or sector has done very well. For example, gold has done very well last 3 years. Doesn't mean that it may not do well over the next 1 year, but because it has done so well over the last 3 years, if you put lump sum money today, then your experience in terms of returns can be a little bit muted, be it in gold or any other segment which has done well. So that's the investor's caution that I would like to say, that don't look at past returns and invest when you're looking at lump sum, and probably be a little more cautious when you're investing lump sum in equity markets, especially at high valuations which exist today.
All right. Thank you so much, Mr. Haria, for sharing your insights. It will surely help our listeners to understand smart beta schemes and make better financial decisions. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. With this, we come to the end of today's episode of the Investment Made Easy podcast. Stay tuned for the next edition in the Outlook Money's podcast series, and don't forget to like, share, and subscribe. If you have any suggestions, feedback, or questions, please send them to us at letters@outlookmoney.com. Until our next edition, take care and keep following Outlook Money, your go to personal finance magazine.